You're 23, your salary is $42,000. After tax, you take home about $690 a week, and your share of a rental in outer Sydney eats half of that before you've bought a single grocery. Then, your Uber driver casually mentions he made $180,000 last year driving nights and weekends. Something doesn't add up about how money actually works in this country. So, what does wealth actually look like? This is your life at 5 distinct Australian salary milestones: $40,000, $75,000, $120,000, $220,000, and $500,000 plus, revealing why the numbers on your payslip tell a completely different story than the life you can actually afford. Let's start at the beginning. You are 23, earning $42,000 a year. After tax and Medicare, you're paying about $4,173 annually, bringing your weekly take-home to roughly $727. With a basic one-bedroom apartment in the outer suburbs running $650 per week, a solo rental means spending 89% of your income on housing alone. That is before groceries, transport, the phone bill, or putting a single dollar away for a rainy day. So you make the calculation every 20-something in Australia makes: share house or financial suffocation. Split a two-bedroom at $400 per week each, and suddenly you have breathing room. The math becomes $400 rent versus $727 take-home. That's 55% of your income on housing. Still brutal by the textbook 30% rule, but survivable. But the superannuation reality hits differently than anyone prepared you for. Your employer contributes 12% of your ordinary earnings into super. That's $5,040 annually you cannot touch for 40 years. On paper, you're earning $47,040 in total compensation. In your bank account, you're living on $37,827 after tax. The gap between what sounds decent and what actually pays the bills becomes your daily reality. This is the entry-level trap. Your social life recalibrates around what $327 per week can actually buy after rent. Group dinners become, "I'll just have an entree." Weekend trips become, "Maybe next time." The Uber your friends casually call becomes the bus you take alone. Electricity bills averaging $150 to $250 monthly mean choosing between turning on the heater in winter and eating out on a Friday night. You become the friend who suggests meeting for a walk or a coffee instead of drinks, who hosts dinner parties with cheap pasta instead of premium cuts of meat. The hidden costs financial advisors never mention start adding up. The bond and first month's rent up front that completely wiped out 3 months of hard-fought savings. The furniture you need but can't afford to buy new. The professional clothes for the office that cost more than your weekly food budget. The emergency fund that stays permanently at zero because every single month brings its own emergency. You are officially in the workforce, but you are living paycheck to paycheck in a shared house with strangers. The pathway to a higher salary becomes your absolute obsession because you've learned the harsh reality of stage one. You have a job, but you do not have money. You are just surviving. 5 years later, you find yourself at the threshold that everyone said would change everything. You are 28. Your salary is $75,000. Your net pay after tax is $58,658 per year, or $4,888 per month. On paper, this looks like the escape velocity you've been chasing since your early 20s. In practice, it is one of the most financially stressful brackets you will experience. You finally unlock the one thing you've wanted for half a decade: independence. Your take-home of $1,128 per week feels substantial enough to justify living alone, so you sign a lease for a modern one-bedroom apartment at $580 weekly in a decent suburb. That's 51% of your income on rent, still heavily above the recommended 30%, but finally manageable without housemates. The psychological relief of your own space, your own kitchen, and your own silence feels like you've finally made it. It justifies the financial stretch. But this is where you hit the solo living squeeze, and the tax bracket mathematics become unavoidable. Between $45,000 and $135,000, Your marginal tax rate is 32% when the Medicare levy is included. Every overtime hour, every bonus dollar, every side hustle payment gets heavily carved up before it reaches your account. If your salary increases by $100, you only see about $65 of it. The gap between gross and net becomes a constant mental calculation. The hidden costs of living alone compound instantly. Electricity bills that were split 3 ways now land entirely on you. Internet, streaming services, contents insurance, all solo. The grocery bill doesn't scale down proportionally when you are cooking for one. Buying single servings is notoriously expensive. Your monthly fixed costs hit $3,200 before discretionary spending, leaving just $1,688 for absolutely everything else. Car payments, fuel, phone, clothes, social life, and that emergency fund that still hovers dangerously near zero. The cruel irony emerges. You are earning 78% more than your 23-year-old self, but your discretionary income hasn't budged and your financial stress has actually intensified. At $42,000, your limitations were obvious and your expectations were modest. At $75,000, you're caught in a new anxiety. You make too much for government concessions or sympathy, but not enough to actually afford the middle-class lifestyle the number suggests. Friends assume you're comfortable. Dating profiles judge you as financially stable. The pressure to maintain appearances while stretching every single dollar creates a specific, exhausting anxiety that lower incomes simply don't generate. This bracket teaches you that salary increases don't translate linearly to lifestyle improvements. That $33,000 raise from your early 20s delivered maybe half of that in actual spending power after tax, rent inflation, and the sheer costs of living independently. You discover that being technically middle class and feeling financially secure are entirely different experiences. Have you ever felt that weird financial tension where you're earning decent money but somehow still can't afford the life you thought that salary would buy? Let me know in the comments below, because this gap between income and actual purchasing power gets even stranger as we climb to the 6-figure mark. 4 years later, you reach the milestone that changes how you view money. You are 32, and your salary is $120,000. Your take-home after tax is around $87,600 per year, or $1,686 per week. For the first time, the numbers on your payslip translate into genuine lifestyle power. You unlock the ability to actually live. An unexpected $400 expense, like a car repair or a dental bill, doesn't trigger a minor crisis anymore. You can confidently pick up the tab at a nice restaurant without quietly checking your banking app first. You start planning for major life events, and you realize that premium experiences like booking that European summer holiday, upgrading to a reliable late-model car, or buying luxury items are things you can tangibly save for without sacrificing your daily comfort. But your new challenge is entirely structural: the property wall. You have excellent cash flow, but zero equity. With the median house price in Australia sitting over $1 million, you need a $200,000 deposit plus stamp duty and fees to even get a seat at the table. At your current savings rate of $800 monthly after all expenses, that is decades to save a deposit while property prices continue climbing faster than your savings account. The math feels like trying to run underwater. You earn too much to qualify for first home buyer grants or affordable housing schemes, but not nearly enough to outbid seasoned investors and dual-income households at auctions. This is also where the hidden costs of middle-class life that no one warns you about start to bite. Private health insurance becomes practically mandatory at this income level to avoid the Medicare levy surcharge. A basic hospital and extras policy runs you a couple of $1,000s annually, money that disappears before you see any benefit. If you went to university, your HECS help debt repayments are now carving a massive chunk out of your post-tax pay, slowing down your ability to save even further. The social dynamics shift dramatically at this level. Friends earning $60,000 to $80,000 start treating you as financially wealthy, expecting you to foot more of the bill or split group vacation rentals unequally. Dating becomes complicated when your income suggests deep financial stability, but your actual wealth, measured in hard assets, not just salary, remains essentially zero. The pressure to maintain the appearances of success while desperately trying to build genuine wealth creates a specific anxiety that lower and higher incomes don't experience. You begin to understand that $120,000 is the income level where Australia's housing crisis hits the hardest. You are financially successful on paper, but asset poor in reality. This is the bracket where you discover a painful truth. In Australia, a great salary buys you a fantastic lifestyle, but it doesn't buy you wealth. Wealth isn't about what you earn, it's about what you own, and ownership remains frustratingly out of reach, despite finally having a salary that should make it possible. 10 years of grinding later, you cross into territory that fundamentally alters your relationship with the government. You are 42. Your salary is $220,000. Your net salary after tax is roughly $145,900 per year, or just over $12,000 per month. You are earning a top-tier professional income, but you've just hit the hardest ceiling in the country. You've finally unlocked property ownership, and your net worth is growing. The conversations change. You aren't just maxing out your superannuation anymore. You have the capital to start looking into specialized plays, like acquiring an investment property, exploring alternative asset classes, or building a robust stock portfolio to diversify your wealth. But the new enemy is the tax office. Your marginal tax rate is 47%. Every extra hour you work, every bonus you earn, every side hustle dollar you generate gets carved in half before it reaches your bank account. The psychological impact is immediate and demotivating. Grinding for a promotion feels pointless when a $20,000 raise delivers barely $10,000 in your pocket. The tax system extracts its maximum toll right as your career peaks. Meanwhile, the lifestyle expectations at this level are suffocating. Private school fees enter the calculation, whether you anticipated them or not. The social pressure at this income level assumes private education as the default, with fees averaging $25,000 annually per child. Your colleagues discuss school zones, scholarship applications, and overseas ski trips over lunch. The expectation that you'll contribute to private health insurance, maintain investment properties, and drive premium European cars becomes an unspoken but constant pressure. The hidden costs compound relentlessly. Professional wardrobe expectations, networking event fees, the pressure to live in premium suburbs that match your income bracket. Your mortgage on a $1.5 million property consumes a massive portion of your monthly take-home pay, leaving whatever is left to cover groceries, utilities, car payments, insurance, and the emergency fund that finally feels substantial but still insufficient for genuine security if you were to lose your high-paying job. This is where you learn that high income and high wealth remain completely different games. Your salary puts you in the top 10% of Australian earners, but your net worth, dominated by a massive mortgage and superannuation you can't access for decades, keeps you functionally middle class in assets. You're asset poor despite being income rich. You are technically crushing it, but because the tax system heavily penalizes wage earners over asset owners, you feel completely trapped by your own high income. You are working the longest hours of your life for diminishing lifestyle returns. By 48, you cross the $500,000 mark. Your total compensation is $520,000. Your net salary after tax is over $300,000 per year, or roughly $25,000 per month. And this is where the landscape shifts entirely. This is where you realize the wealthy operate by completely different rules than everyone else. You've unlocked the final level, buying back your time. You no longer worry about budgeting for groceries, unexpected medical bills, or premium holidays. Property ownership is straightforward. You aren't shopping for a family home anymore, you are building a property portfolio. But the challenge here isn't earning money, it is protecting it. Your effective tax rate is massive, meaning nearly half of every additional dollar disappears. Losing over $200,000 annually to taxation creates a mandatory mindset shift. Every financial decision becomes a tax optimization problem. Your $8,000 a year accountant isn't an expense anymore. They are your most valuable asset. Professional tax planning isn't optional at this level. It's essential for survival. At this level, you stop caring about your salary entirely. You realize that high income is just the entry fee to the actual wealth-building game. The social isolation intensifies in unexpected ways. Friends earning $150,000 assume you're wealthy enough to cover group dinners without discussion. Meanwhile, colleagues earning 7 figures treat you as middle management, excluding you from their private equity discussions and overseas investment syndicate opportunities. You exist in a financial no man's land where you are far too wealthy for sympathy, but not wealthy enough for the exclusive investment opportunities that create genuine, multi-generational wealth. The investment pressure becomes constant. Financial advisors pitch managed funds, commercial property syndicates, and complex overseas structures. Every conversation assumes you have spare capital to deploy, but the reality is that high income doesn't automatically translate to high net worth when lifestyle costs, like private school for multiple kids, a mortgage on a $2.5 million home, and the fixed costs of maintaining a professional image, scale proportionally. You look back at your 23-year-old self and realize the biggest lie you were ever told, that working harder for a bigger paycheck was the ultimate goal. The pathway to genuine financial independence remains surprisingly narrow for wage earners. The tax system penalizes every dollar of additional salary, while the truly wealthy build assets that generate tax-advantaged returns. The conversations aren't about raises. They are about family trusts, franking credits, capital gains discounts, and business equity. The realization hits. Wealth isn't about what you earn annually. It's about what you own permanently and exactly how you structure it. If you want more no-nonsense breakdowns of how money actually works in Australia, hit subscribe. And make sure to stick around, because in the next video, I'll be breaking down building assets at every level. I'll see you in the next